Hey everyone, and welcome back to the show. Today, I'm very excited to introduce our guest for today, Mike Morawski. Mike, thank you so much for being here.
Hey, thanks for having me. I appreciate being here.
Yeah, definitely. I mean, there's so much interesting, important lessons to learn from your story. So thanks for coming on. Why don't you start by, Mike, you've obviously had a very long career in the real estate space. Why don't you take us back in time and tell us what drew you into real estate?
You trying to make me feel old, by the way? um, I've been in real estate for 30 years.
Yeah, that's a long time.
Yeah. And I've seen a lot though. I've seen a bunch of different cycles and a lot of things happen, and it's been an interesting number of years, which we'll get into a little bit. But I went into I've always believed that success leaves clues. I think I heard Jim Rohn say years ago that if you do what other successful people have done, it helps your chances of being successful. So I happened to be in the construction business, and I woke up one morning and I was just burnt out. I couldn't do it anymore. We were doing kitchen and bath remodeling and building room additions, and I had a pretty big company, and I was still banging nails and trying to do all of the on the business stuff, trying to grow the business and do the bookkeeping and working in the field. And I was burnt out. I couldn't do it anymore. So I sold the company and I took a year off. And during that year, my wife and I at the time house hacked a couple of houses.
Mhm.
Now, this was long before it was the sexy thing to do, right? People do it now and it's fun and they love it. But back then, it was kind of new for everybody. And along the way, I met a real estate agent who was very successful. And I thought, God, I really like what he's doing, and I like that he's, making money. And so I went and talked to him, and I said, Hey, Todd, I'm thinking about going in the real estate business. And he really encouraged me. He said, I think you'll be great at it. He said, you're good with people. You like to build relationships. You're tenacious. I said, great. So I go into the real estate business, and I said, Hey, could I come and shadow your team? And could I follow you around and learn what you do? He said, No. I was like, Okay, great. He said, I'm going to do better. I'm going to make you a cassette tape. So now I'm really dating myself
Uh-huh.
because I don't know that you can make any or find a machine to make a cassette tape on today.
I remember cassettes, but they were on their way out for sure.
Yeah. Yeah. So that's good you remember cassettes, though. Um, So he made me this cassette, and I listened to it over and over and over again. And I went into business. My first 9 months in the real estate business, I sold 78 houses. I went
Wow.
on to build a team selling 125 a year, and we did that consecutively for about 8 years.
Hmm.
2005 came around, and I saw the market starting to shift and change, and I knew I was going to have to do something else.
Hmm.
So again, success leaves clues. When I was in the construction business, I did a lot of work for a couple of apartment syndicators.
Hmm.
And I really understood the business. I understood that if you raised private equity and you found a great real estate deal, you married them, you stayed in the middle, and as long as everything went well, you everybody made money, and it was great.
Hmm.
So I syndicated my first deal in 2005. And I said, wow, this is going to be great. I put a little $45 ad in the newspaper and said real estate investors wanted, and I raised a $500,000 from that ad.
Wow.
So I went on over the next 30 months to raise $18 million. I bought $60 million worth of real estate. It was about 4,000 apartments in 5 states,
Hmm.
and built a property management company managing 7,500 units. And we did that.
Amazing.
Yeah, we did that in 30 months. Um, Now, some challenges came along with that, right? I grew way too fast. We were
Uh-huh.
very unstable. In 2007, I closed 17 deals for 2,700 units in three different markets. We hardly had time to breathe. And so I always tell people, I say, hey, it was like balancing a stool, sitting at a kitchen counter on two legs, trying to pick your feet up off the ground. It's
Yeah,
kind of tough to do.
for sure.
So, um, so we grew very unstable. I didn't raise enough capital. I was undercapitalized and over leveraged. And
Hmm.
this is the warning I always tell people. I say, hey, I bought $60 million worth of real estate at 85% loan to value when we should
Hmm.
have been 65 or 70%. And I always, kind of kiddingly, I say, hey, I don't know who was more at fault, me for taking the money or the banks for giving it to us, you know?
Yeah.
So, uh, so today I'm in the coaching and training space because of all that stuff that happened along the way.
Yeah. Wow. Well, that's first of all, it's amazing that you were able to grow so quickly. I mean, I know that's a goal of a lot of people, and it's interesting to hear you say, I grew too quickly. And another thing that you mentioned about leverage, and this is something that one of my mentors taught me, is that leverage is usually the reason why real estate deals go poorly, right? And so incorrect structuring of deals and having overly leveraged properties is the reason why deals go south really quickly. And so, yeah, interesting that that's how you were able to build your business so quickly. What happened next?
Yeah. So as I said, I was over leveraged, or and undercapitalized. 2008 came around, and it was like we hit a brick wall at 200 miles an hour in a freight train, totally derailed. Um, and we're kind of left wondering what was going to happen. And I thought that we'd be able to weather the storm. And like I said early, I said I've seen a lot of ups and down markets. So I've seen recessions in the past, and they usually last 17 or 18 months, maybe a 10% correction. But this was different. This lasted 7 or 8 years, and the correction in the market was like 40%. So I
Mm-hmm.
had people move out of my properties. I couldn't pay my bills, couldn't pay my investors. And I thought, I had a number of deals that were in trouble, and I should have just let them go to foreclosure and let a few investors get hurt. But that's not who I am. I wanted to save everybody, and I wanted to, be the hero and make sure everything was fine. Well, I started to move money back and forth between companies. So I took money from profitable companies and started putting it in non-profitable companies, trying to shore them up.
Mm-hmm.
And, I had 38 different corporations, 38 different companies. And my accountant and attorney both said, hey, it's okay to do that. Just leave a paper trail. And when the market comes back, you can put the money back and straighten everything out. I said,
Mm-hmm.
okay, that was fine. It's not illegal what I did, but what happened was we didn't disclose it to our investors. And because I didn't disclose it to my investors and tell my investors what we were using capital for and how we were moving it, I wound up being charged on wire fraud and mail fraud charges and sentenced to 10 years in federal prison
Oh
for,
my God.
yeah.
That
Um,
is that's a very hefty penalty.
yeah. Yeah, no doubt about that. I think it was a little over exaggerated, and I take full responsibility for what I did, right? I didn't tell my investors. I should have told my investors. I should have let some deals go to foreclosure and not try to save everybody. Um, but we all learn by mistakes, right?
Yeah, for sure. I mean, mistakes are the greatest teacher, but such a difficult punishment is, so did you stay in for 10 years and how did that go?
Yeah, so great question. So I go to prison and I really think my life is over, right? I go from living this pretty modest middle class lifestyle. And I always tell people, I say, I never flew private. I didn't have a boat. I didn't buy a bigger house or fancy cars. I was the neighborhood baseball coach and soccer coach. I was home most nights for dinner, and I had a great marriage.
Hmm.
And I got ripped from that and put in a 12 by 12 room with three men that I didn't know, and had three green outfits and five pairs of underpants, wondering what happened in my life and how I was going to get through each day.
Hmm.
So, I thought my life was over.
Hmm.
And I'm wondering, how am I going to do this? Well, I was probably in prison about 17 days, and my wife decided she was going to divorce me and kind of wipe me out, just really kind of ruined me. So the funny thing about prison is, dark and evil as it is, people gather around you and lift you up and help you. I've met some really great guys, and today I have some really good friends that I met in prison that we have stayed close. And but here's what happened. I was probably in prison about 6 weeks, and now you have to remember, I went from running marathons to being 35 pounds overweight, hating myself, wondering what did I do.
Yeah.
And so I walk in the gym one day, and this guy walks over to me and he goes, hey, look, he goes, I know you're struggling. He goes, don't let these people beat you. All they want to do is take everything from you. They want to take your real estate. They want to destroy your businesses. They'll take your money. They can destroy your family. But what they can't take is who you are. and they can't take what you're made of. They can't take what caused you to build those successful companies that you have. And yeah, you made a mistake and you stumbled, but you can go get that all back. He said, get that 10 years back. He said, start today to change who you are. I thought, man, here's some guy with some advice that I really don't want to hear. But again, I know that he's right.
Who
So I
was he
started,
in the?
uh, he was just a guy that was an inmate in prison. He was actually about 20 years younger than me and just had this wisdom, right?
Mhm.
Um, I believe God puts people in your lives at the right time for the special things. And, he
Yeah.
showed up. So I started going to his class, working out every day, started losing weight, started feeling better. I decided to go to college. I got a bachelor's degree in theology. I wrote two books. One is called Exit Plan, Your Complete Guide to Multifamily Investing and Why You Need an Exit Plan Before You Buy.
Mhm.
I'd love to give a copy away to your listeners at the end of the show.
Awesome.
Yeah. And I wrote a book on property management, which is being edited right now. And so uh, I wrote two home study courses and I wrote an ethics course. I taught real estate investing and property management. I taught ethics for 5 years, 6 years in prison. I taught Bible study. I was on an outreach program. I went into the community like 40 times. I told my story to local businesses and college students
Mhm.
and met a professor from the University of Minnesota. We actually co-authored a paper together that we had published this year in the Business Journal of Ethics.
Mhm.
It gets taught at the collegiate level uh, for forensic accounting classes and sales and marketing classes. So, and that brings me to today, right? I'm home. I'm in the coaching and training space, and I teach multifamily investors how to scale their business, how to come into the real estate space, but not make some of the mistakes I made,
Mhm.
and how to live a more balanced lifestyle.
Yeah, for sure. Yeah, that's amazing, Mike. I mean, just anyone who it gets put in that situation and comes out of it with like a good head on their shoulders and an ambition to still live a good life is just, I mean, I just have so much respect for that. And there's clearly so much inner work that you had to do to be able to come out stronger. So um, thanks for sharing your story. And, I'd love to hear some more about what you like to teach your students. I mean, obviously you have entire courses and but is there anything you want to share with the listeners about some of the lessons that you learned along the way?
Yeah, I think we kind of talked about it early on. If I had to say there were five things that happened, one was that I grew too fast,
Yeah.
right? And everybody wants to get in the business and they want to have 1,000 units under their belt before they know it and start doing institutional financing. And here's the deal: take your time, learn the lessons you need to learn, go slow. You know, Today we do these multifamily deals and we put partnerships together where before I used to do everything myself, right? We got the loan, we raised capital, we managed them. Now you put partnerships together. I got a great partnership with some people today where we're doing deals and raising money. And that's the good thing too, right? I'm home now and I actually have legal opinion written that says that, according to the SEC, that I can go back and be an issuer and raise money and raise capital, and which is really kind of cool. So, they basically said, go back in the business, right?
Hmm.
Um, the other thing was I didn't raise enough capital. So
Hmm.
when you're underwriting today, make sure that you're over raising. It's
Hmm.
okay to over raise a little bit and have some reserves in the bank in case there's a problem. Look at how you're going to cover yourself in that gap if something happens. That's why I
Hmm.
didn't look at that, right? I didn't look and say, hey, I know that I can operate at 15% physical and economic vacancy, but what happens if the market shifts and I go to a 30% vacancy? How am
Hmm.
I going to cover that? It's okay to over raise money and put some money in reserves.
Yeah.
Uh,
And
don't over leverage. Go ahead. What? I'm sorry.
well, do you have like a rule of thumb that you might, I mean, I guess you kind of spoke to it, but like for reserves?
Well, I think, when you look at reserves today, the bank wants you to have about $300, $350 per unit. I think that's a good place to be. right? So
Yeah.
if you take your reserve line when you do your underwriting and you say, okay, this is going to be, I'm going to take this number over and above everything else that I need, that I think that keeps you in a little bit safer position,
Okay.
right?
Yeah.
But here's the spread, right? So you would look at a deal and say, okay, I've got a 10% vacancy factor and a 5% loss to lease. That
Hmm.
gives me a 15% economic vacancy, right?
Hmm.
So which is fine because operations, today are running pretty well. I used to buy deals that were 78% vacant, 72% vacant, and we drive them to 90, 92% occupancy. And now all of a sudden, um, you're in a really good position. But one of the questions investors would always ask is, hey, what's the worst thing that could happen? And I would always say, kind of laughing, well, everybody'd move out. I never thought occupancies would drop 30%.
Hmm.
So if you go from 90% and you have a 30% drop in occupancy, how do you cover that cost?
Hmm.
Plus, my bills were too high because I was over leveraged. So I was 85% loan to value versus being 60 or 70%, 65 or 70% LTV.
Hmm.
So, like I said earlier, right? I mean, who was more at fault, me for taking the money or the banks for saying it was okay?
Yeah.
Um, and then, I think the big thing is I didn't listen to people around me. I didn't pay attention to the red flags.
Hmm.
And some of those were, if I look at it in 2008, I was closing a deal and um, couldn't get the funding from my office and finally get my partner on the phone. It's a Wednesday afternoon. And I say, he says to me, hey, I don't know how to tell you this. And I'm like, you don't know how to tell me what? I'm trying to close a deal. I need $500,000. He said, I took the money from the escrow account and I put it in the operating account. I said, you're not supposed to do that. We had this conversation before we ever, he goes, I know. I thought I could have the money back. I said, okay. So I wound up dry closing, which meant we signed all the paperwork. And I said, I'll have this funded by Tuesday. So that was Wednesday.
Hmm.
Now, I never told my wife about business. You know what I'd say, hey, things were great. I met a new investor. We closed a deal. I never said any problems. No, you know. On Friday night that week, we go out to dinner. Her, myself, my ex partner, and his wife. And on the way home, out of clear blue nowhere, she says to me, I don't trust him. I don't like what's going on. And I say, thinking I'm a good husband, I go, hey, honey, don't worry. I have this under control. And I didn't have anything under control.
Hmm.
What I should have said was, hey, honey, tell me more. Tell me what you don't understand or what
Hmm.
you don't trust about him.
Hmm.
Um, so I wound up closing that deal. I raised a little bit of money over the weekend. I gave some equity away in the deal. I wound up funding that deal. And on Wednesday the following week, I'm at lunch with my attorney. And my attorney says, hey, I don't like what's going on.
Hmm.
I think you need to take a look at your partner.
Hmm.
And I'm like, Bob, don't worry about it. I've got this. This is fine. And
Hmm.
I didn't have anything. I didn't,
Hmm.
and I knew that these people that were telling me this were right, but I thought I could fix it. And
Hmm.
so I tell that story because, first of all, um, if you're a man, listen to your wife because I think they're smarter than we are, right? And
Uh-huh.
that's why we get put together. So
Hmm.
that's one lesson in that. And another lesson is listen to the people around you because you might see something going on that I don't see. And if I don't pay attention to that and I don't listen to you, I can miss that. And by missing it, I can make a mistake.
Hmm.
So, people in our lives are in our lives, um, hey, there's a proverb that says, wise men seek much counsel. And
Hmm.
today, that's how I live my life, right? Is I want to know what other people think. I've got some strong people around me today, and I run everything by them. And
Hmm.
I think that's what we need to do as business owners, as managers, as syndicators, as operators.
Yeah, I mean, I think it's such an interesting point because, like, for example, you had consulted your attorney and your accountant about moving the money, and they had said it would be okay. So, what do you think went wrong there? Because clearly, like, either they missed something, something was missed.
Yeah. So non-disclosure.
Hmm.
Um, didn't tell the investors what was happening. Um,
Did they tell you? I mean, they didn't say make sure you disclose it.
no,
Hmm. So, I mean,
no,
it's kind of hard
but
because like there's so much to understand and know, right? Like you clearly didn't know that you were breaking the law when that happened.
I had no idea. I actually came back from vacation in 2010, and my ex partner handed me a business card and said, "Hey, you need to find a criminal attorney." I was like, "A criminal attorney?" I said, "Hey, look, I knew we were in trouble, but what'd you do? What'd we do?"
Hmm.
And so that was the beginning of the end,
Hmm.
uh, and an interesting progression, right? So I didn't really realize we were in that deep of trouble. I didn't realize that it was criminal what was going on, which was that we were moving this money and just not giving enough disclosure to the investors about what we were using the money for. So
Right.
then when people and you know as well as I do that real estate typically is not liquid, right? So if I call you up and say, "Hey, I need my money out," you can't give me my money out.
Right.
So we had some people that wanted their money back, and we couldn't do it. So they went to the FBI, and the FBI opened this investigation. There were a couple other things that went on. One was that we were a victim in another case, somebody else who got indicted, and these people called the FBI. It was kind of a comedy of errors.
Hmm.
So now they start looking at us, and listen, I broke the law, and I take responsibility for not telling my investors, and I'm sorry for that.
Oh yeah, I mean, I think my question is just like, if our attorneys can't, tell us if like we need to be able to rely on, some kind of counsel to make sure we're doing the right thing. So that was kind of my question. Like I know,
Yeah, somebody asked me the other day. They said, "How do you trust people?" And I said, "God, I don't know." I said, I said, "For me today, it's more about forgiveness than it is about trust, right?
Mhm.
Like I have to forgive those people in my life that um, helped some of this to happen,
Mhm.
right? Um, but you know, we kill trust. Trust we lose by pouring a bucket out, right? If you have a bucket full of trust, you dump it out in one full motion, and it's gone. But to fill it up, you fill it up by teaspoons, right?
Mhm.
It takes time.
Mhm.
So, um, I work with an attorney today, a securities attorney today, who does our business stuff and does our security stuff, and I have to trust them.
Mhm.
Can't not, right? Because um, I have to, we got to walk down this road. So,
Yeah, for sure.
you've
No,
got to take that advice.
yeah, for sure, definitely. Yeah. Well, thanks for so much for sharing, about that part of your story. I'm curious if there's any other sort of underwriting lessons that you might be able to share. I know that's a passion of yours.
Yeah. Hey, thanks for asking too, because it is a passion of mine, and
Mhm.
I love, it's kind of funny because going to school, I hated math, and I was always like, God, I'll never need this, right? I'll never use this, but I've kind of gotten this affinity for math today, right? And I love the numbers because the numbers tell the truth, and um, you're not going to put the numbers in a couple different ways and get a couple different answers. They're
Mhm.
going to tell the truth.
Mhm.
So I have a pretty robust spreadsheet that I use when I do my underwriting, and I've gotten to really have this love affair with it because it tells me whether a deal is good or bad.
Mhm.
So when I underwrite today, I want to be conservative, right? First of all, I'm going to be in a high rent growth market. So if you look at rent growth right now nationally, it's about 3.9%. But if we are looking the Chicago market where I'm at, it's like 1.7%.
Mhm.
So I really don't like Chicago for that reason. I
Yeah.
want to be in a market like Tampa or Dallas where the rent growth is more, 7%, but I'm underwriting at 5. So
Mhm.
I'm underwriting my rent growth somewhere between 4 and 5%. I'm taking a going in cap rate today that's still compressing, and I might be underwriting it at 25 basis points higher per year through the time I'm holding that deal.
That's quite a cushion.
Yeah. So, um, which gives you less deals to look at, but now the ones you look at make more sense
Hmm.
because there's really only three metrics that you have, right? Or levers that you can pull. You can pull purchase price,
Hmm.
which you can only go so far on purchase price. You
Hmm.
can pull rent growth. You can manipulate that any way you want. So, somebody says to me, hey, but this guy's got a deal that they're paying 19% on and a 9% cash on cash. I said, well, here, look, watch this. I can do this, change my rent growth, and oh, look, we've got the same metric. But I'm being conservative at
Yeah.
saying, I'm going to pay you 17% IRR because my rent growth is only 4%, not 5.
Yeah. I
So
mean, and 17 IRR is still very strong.
yeah, right, right. So what I promise people today is, hey, look, we're going to get you to an 8% cash on cash and a mid-teens IRR, right? So
Yeah.
I think that's where people like to see anyhow right now.
Hmm.
So
For sure. Yeah, no, I think those are all very, I mean, sometimes I've heard different numbers kind of thrown out for that exit cap. And maybe just, I mean, obviously that's common knowledge to you, but just for our listeners who might not be familiar with the exit cap, can you just briefly go over that?
sure. So your cap rate is I always tell people that the short explanation of cap rate is this: is if you pay $1 million for a property and you pay cash for it, and the cap rate is 4%, you're going to make 4% on your $1 million every year. You make more money on the leverage when you have, loan on it, and then your depreciation and everything else. But, the straight line on cap rate is if you pay cash for the property, that's what your return's going to be.
Hmm.
So today, when we're looking at a deal, most deals in the markets we're going into were somewhere right around a 5, if not south of a 5.
Hmm.
So it might be a 4.5, a 4%. I've even seen some 3% cap rates going in. So coming out, if I'm projecting a deal 5 years, 6 years, 7 years from now, what are those cap rates going to be? I think right now, just based on some, and I'm not an economist, right? But I've listened to enough and I've studied some of this stuff to say, I think that we're going to see cap rates compress in the next couple of years a little bit more. We're probably going to see 3% cap rates in some of these high rent growth markets.
Hmm.
Um, but they're probably going to accelerate a little bit. So if I started a 4.5% cap rate today going in, and I add, 25 basis points a year, that takes me to a 6, a 5.5 on the way out. So that I think that's enough cushion to give me comfortability as an operator that um, I can sell that deal at that number. And then the other thing that I want to check is my price per unit and take a look at the going out price per unit. Is there anything in the market today that's selling close to that?
Hmm.
So if there is, then there's a good chance I'm going to hit that other metric. So
Yeah, for sure. Yeah, I think those are some really good things to look for. So thanks for going over those.
sure.
And I know you also wrote a book called Exit Plans, as you mentioned, right? So
Right.
obviously we just talked about cap rate and exit caps. Is there anything else you want to share about exit plans? And I know you said going in with an exit plan is really important.
Yeah. So, exit planning for me is really important. I read a book years ago by Stephen Covey called Seven Habits of Highly Effective People.
Hmm.
Chapter 2 in that book was start with the end in mind. And it
Hmm.
just kind of always stuck with me. But I spent hundreds of thousands of dollars over the years going to these seminars, reading books, listening to tapes, and some really great trainers. And what's funny was I always left kind of empty, like I was missing something. And it was interesting because people always teach you how to find a deal, how to get in a deal, how to operate a deal. Nobody ever teaches you how to get out. And
Hmm.
it occurred to me one day, man, we need to be talking about the exit because we need to be talking about it before we ever close on the deal.
Hmm.
Because I need to know what my profit's going to look like,
For
right?
sure.
Because if I can strategic, there's that old saying in real estate that says, hey, you make money when you buy the deal. It's true, but you don't realize the gain till you get out.
Right.
So how do I do that? Exiting doesn't necessarily mean I'm selling the property. I could refinance, I could recapitalize, I could bring a partner in. There's a number of ways to exit a deal, but know how you're going to do it and what are your plans along the way.
Hmm.
So, how am I buying it? What's my structure around that? What are my operational structures? What are my capital improvement plans?
Hmm.
What is my return on my renovation going to look like? These are all things that we need to look at to create that exit plan.
Yeah, for
Because
sure.
if I run a 10-year spread in my underwriting and I see at year seven that that's my most profitable point, well, I probably want to do something at year seven to pull my profit off the table and rerun the deal.
Hmm.
So if I can do a capital event of some sort at that point and do a principal pay down, you can do a cash out refi and, that's tax free money. You can pass that through to your investors. There's so many different options that you have. People don't talk about it.
Yeah.
What was interesting, and I just tell this real quick.
Yeah.
I read a book. It had 380 pages by a really famous author, and I got to like page 370, and the author says, in a small paragraph, now that brings us to exit plan. And I thought, God, we should have been talking about this at the beginning, not at the end.
Hmm.
So, it's interesting. He says, all your hard work, now you want to capitalize on your exit. Well, you should have known that early. So,
Yeah, totally. I love that. Start with the end in mind, kind of know where you're heading so that you can keep reorienting towards, and having multiple exit options, right, is also um, really helpful, especially in changing markets. So I just want to touch on one thing that you mentioned kind of briefly, which is if year seven was your most profitable year, then that would be a year can you just expand on that? So when you say profitable, do you mean like when your net NOI is the highest or what do you mean there?
yeah, I think when you're going to see a spike in your cash flow and you'll see a spike in your IRR.
Hmm.
So, even if I straight line my cash flow, my objective as an operator is to pay a preferred return, right? So if I'm going to pay you 8% a year, and then I say, well, listen, if I get to 12, the business deal changes. So now we go from a 70-30 split to a 60-40. I'm going to work harder because I'm going to make more money at that point.
Hmm.
So how do I get the deal to a 12% cash on cash return? And then even push it beyond that. What if I can get the deal to a 15% cash on cash return and the deal changes again to a 50-50 as an operator?
Hmm.
So that's going to cause me to work a little bit harder to operate that deal more efficiently so that my investors and my key partners are all benefiting from it. So what I want to look at is it might not be year seven, it might be year three
Hmm.
where I hit the highest point. And I run that metric. What if I hold it for 3 years? What if I hold it for 7 or 5? Right? Because you'll see how those numbers change.
Hmm.
And so that's why I like my tool, right? Because in my tool, I can put my years hold, how
Yeah.
long I'm holding the deal. And then I can take a look on the spread and say, oh, here's my most profitable point. I'll do some financial event here.
Hmm.
So
Okay.
I hope does that help answer the
Yeah,
question?
totally. Yeah, makes sense.
Great.
I haven't heard anyone explain it like that. So, yeah, thanks very much. Well, we're getting pretty close to time, Mike, but obviously you have so much more that you could share with us. Is there anything else you want to leave the listeners with, like any sort of last words?
Um, you know, Actually, if people want to get a hold of me or grab my book, they can do
Absolutely.
that. Yeah. Last words would be just be cautious. Don't not invest today. I think we're all watching kind of shades of the world changing a little bit here and wondering what's going to happen. Maybe waiting for the left shoe to fall, so to say. I see shades of 2007, 2008 going on a little bit, but that shouldn't give you it should give you cause for pause just to take a look at what's going on and how should you do things differently, think things through a little bit more, but don't not invest, go
Hmm.
invest. because it is a good time and it's robust, and you
Hmm.
might as well take advantage of it.
Hmm.
So,
For sure. Yeah. I mean, I think those are really wise words coming from someone who, saw what happened last time around. So yeah, when you say be cautious, I mean, I know we talked about a few different things to look at. So leverage, like the amount of leverage, the how aggressive the rent assumptions are, and just in general, taking a conservative look at deals. Is that what you would say?
yes, absolutely. Just be conservative. I come from an old carpenter background, and the method, theology behind being a carpenter is measure twice, cut once.
Hmm.
So, we should do that, right? We should check everything and double check everything. And if we're still not sure, check it again. So,
Yeah, for sure. Okay, so thank you so much, Mike. How can the listeners get a hold of you? How can they download your book? Tell us
yep.
the goods.
Absolutely. So if anybody wants my book, they can go to my website, go to mycoreintentions.com/exit plan, and you can download an ebook. And here's what I would say. I'm going to warn you that somebody told me one day, they said, I'm late because I was downloading your book. It's 260 pages. I said, well, I said it was a book. They said, yeah, but most online books are 20 pages. I said, no, yeah, this is a book. So um, so beware of that. And then if you want, I welcome networking. I'm very open to building relationships. You can reach me at mike@mycoreintentions.com. And I'd love to have a conversation or answer any questions or help anybody if I could. So, and besides all that, I'm on social media everywhere. So,
For
yeah.
sure.
Yeah.
Well, I definitely hope you all take some time to check out Mike's stuff. He clearly has an amazing story and a ton of wisdom to share. Thank you, Mike, so much for coming on. Really appreciate it. And yeah, hope to see you again in the future. Have a great afternoon.
You too. Thank you.